Think of a rubber ball bouncing down a flight of stairs. Each bounce is a little weaker than the last as it loses momentum, until it finally just rolls off the edge. In the stock market, failing bull rallies act exactly the same way. This is the three falling peaks pattern. Because it's a reversal signal, we first need to see a clear, established climb. You cannot have a collapse without first building some altitude. Once we hit the top, we watch for the bounces. The rules here are strict. Peak 2 must form at a lower price than Peak 1, and Peak 3 must be strictly lower than Peak 2. No ties allowed. But a downward slope isn't enough to trade on. We find the lowest valley between these peaks and draw a horizontal line. This is our confirmation threshold. The setup is only valid when the price definitively breaks and closes below this exact line. What you are looking at is the visual footprint of exhaustion. Buyers are systematically running out of capital, pushing the price up with less force each time, until they finally surrender control to the sellers. That idealized model is easy to spot, but open any real stock chart and you are instantly hit with a wall of jagged, chaotic noise. Finding true peaks in this mess requires a specific filter. This candlestick chart for Airgas illustrates how we filter that noise using the rule of proportion. Valid peaks in this pattern need to share a similar size and shape. We are looking for structural shifts in the market, not random daily volatility. Look closely at the peaks labeled A1, A2, and A3. Notice how they share a similar visual weight. They are wide, rounded, and take roughly the same amount of time to form. Because their proportions match, they form a valid structural series. Now look at the sections marked C and D. These are narrow, 1 or 2 day price spikes. They belong to a completely different class of movement. When counting your 3 peaks, you have to ignore these tiny blips completely. If you mix wide structural peaks with random 1-day spikes, you will see patterns that aren't actually there. Failing to apply this proportion rule is the primary reason inexperienced traders misidentify the setup and lose their money. Let's put that filter to the test. You are the analyst. Out of these 3 chart sections on screen, A, B, and C, only one contains a true tradable 3 falling peaks pattern. Pause the video. Evaluate each section against the rules we just covered: proportion, strict descending order, and confirmation. Which one is valid? Let's start with section C. If you trace the tops of these peaks, they are actually moving upward. This invalidates the entire premise. We are looking for failing momentum, not a steady climb. Next is section A. The shapes look proportional, but zoom in on the second peak. That single tiny candlestick wick pushes just slightly higher than the first peak. There are 0 exceptions to the descending rule. This one is a trap. That leaves section B. The proportion is perfect. The 3 peaks descend exactly as they should. But watch the price action at the bottom. It bounces upward instead of breaking the confirmation line. The pattern never confirmed. The answer is none of them. Trading requires absolute discipline to the criteria. An almost perfect pattern is not a signal. It is an illusion that will drain your account. This chart for ADC telecommunications shows exactly what a profitable signal looks like in the wild. It survives all of our structural checks. First, we verify the established prior uptrend on the left. Next, we spot our 3 peaks. They share a similar blocky structure, and they form a strict descending sequence. Finally, we map the lowest valley to set our horizontal confirmation line. The setup is locked. We wait. Right here, a daily candle breaches the line and closes below it. The pattern is confirmed, and the floor falls out. The price plunges exactly as the exhaustion in the peaks predicted. Whenever you evaluate this setup, run it through this 4-part checklist. 1. Confirm an existing upward trend. 2. Verify 3 strictly descending peaks. 3. Ensure the peaks are proportional in shape and size. And 4. Wait for a definitive close below the confirmation line. Chaotic chart noise doesn't have to be intimidating. By combining the patience to wait for confirmation with the discipline to demand perfect proportions, you can read the psychology of the market and find highly predictable, actionable trades.